I still remember when I made my first $10 doing stock options. Right now I scaled that to roughly $1,000 per day, so $30,000 per month. So in this video right here, I'm going to break down exactly how I do stock options and how you could do this right now to scale your portfolio. If I can make $10 a day, why could I not make $100 a day and then $1,000 a day? And then eventually I plan to scale this to $10,000 per day. $969,000 is what I grew this account to in just a few years. You can see my 2-year return is $602,000, so it's been going really great. But honestly, once you have a good option trading strategy, you know how to manage risk, and you really know how to do this stuff in a low risk way, you will scale your portfolio just like this too. So we're going to look at these two trades right here on Nvidia. They're two very different strategies, but they're both bullish strategies. So when you want to make a trade on something, you have to understand, am I bullish or bearish on this stock? Do I expect the stock to go up going into the future? Because you don't want to go make an options trade where you want the stock price to go up and then it actually goes down. You're going to lose money on that trade right here. So if we look at Nvidia right here on a 1-month chart, you can see it was up here around $147 per share, and then it took this really big dip down here to about 118 bucks per share. There was rumors coming out that they weren't going to need as many Nvidia chips, so that's why the stock got hit super hard. But when you understand how Nvidia works and how the AI field is actually evolving, you would know that this is a dip buying opportunity right here, and that is exactly what I did. So I bought calls and I sold puts. The one strategy is basically like swinging for home runs, but the other strategy is swinging for base hits. I like to do both strategies because some strategies you just get monthly cash flow every single month, but some strategies you could go in 5 or even 10 extra money on them. So that's what we're going to break down right here on these two Nvidia plays that I made. Another reason why I picked Nvidia just beyond this dip right here is because I felt like the stock was trading near its true intrinsic value up here in the 145 range right here. So when it went down to 118, I knew that it was on sale. Intrinsic value is just what do I really feel like the stock is actually worth? And they're growing earnings like crazy. I feel like the company is going to be way more important going into the future. There's just a handful of reasons why I want to own a company like Nvidia. So I made those two option trades. So we're going to look at the one first right here, which is swinging for the home run. So right here, you could see I bought a 125 call on Nvidia. So as you can see right here, Nvidia is 138 bucks per share. So if you want to go buy the shares right now in the open market, 138 bucks per share. But with the option trade that I did right here, you got to think about it. I could go buy these shares for $125 per share anytime between right now and 1/15 of 2027. So what do you think Nvidia price is going to do in roughly 2 years from right now? This is allowing me to buy for 125 bucks per share. It's already at 138 bucks per share. It did a pretty quick rebound. I got into this trade somewhere around the 120 level, so I'm up roughly $18 per share since I went into it. But remember, I bought the options contract. So you can see right here, I bought it for $37,000. Now it's worth $48,000, and that's where you have the $10,000 profit right here. So this is the play right here where you're swinging for the home run. But I want to show you that these two work together, and it's very, very key to understand both. So I'm swinging for the home run right here. And another really, really important thing about this trade before we go into the cash flow trade right here, where I get roughly $1,000 a day, you have to understand that this trade right here is roughly 5% of my portfolio. So you don't want to go too hard on any certain trade because just face it, things happen in a market. It's not always going to play out exactly how you think it's going to play out. So you don't want to have all your eggs in one basket. But when I do make a trade, I want to have a very high margin of safety, and I want to have a lot of conviction in that trade before I go and do it. So this is a play right here where I'm swinging for the home run. And basically, if Nvidia goes to 300 bucks per share by 1/15 of 2027, in theory, this contract's going to be worth $300,000, and I could buy 1,000 shares for 125 bucks per share, even though they might be worth $300 per share. So I could then take those 1,000 shares and go sell them for $300,000, and I'll make that profit. It's going to be a really, really fat profit on that trade. That's what I expect to happen. Of course, it's not guaranteed, but that is a swinging for home run play right there. So now we have to go into the play where I generate thousands of dollars per month, roughly $1,000 a day in options cash flow. And like I said before, I remember when I started out, I was making $10 a day maximum, but I was super excited to make that first $10, and I knew if I can make $10 per day, what is stopping me from making $100 per day? If I can make $100 per day, what is stopping me from making $1,000 a day? That is the scale of how this strategy works. If you could do it consistently year after year after year, your trades will scale as your portfolio scales. So that's why I started selling puts quite a bit. Now, there's a couple things you have to know before you just want to go and sell puts. You have to do it on a company that you feel like is trading cheap. So that's why I sold the put on Nvidia after this dip, because I thought it was cheap at the 147 price level here. But once it dipped down to 116 bucks per share, I knew that it was even cheaper, and I knew that there was fear in the market, and I like to be bullish when there's fear in the market on companies that I'm already bullish on. You want to be fearful when other people are greedy, and you want to be greedy when other people are fearful. That's what Warren Buffett says all the time. So I was being greedy on this dip right here when everybody else was being fearful. So what I did was I sold a put right here. That's why you see this negative number right here, because I sold the put. Now what happens is I collected $21,000 in premium to my account immediately. So what is premium? Premium is just the instant cash flow that I get by selling somebody this put contract. So then what I did was I took part of this cash flow right here and used it to buy these call options right here on Nvidia. Now I get it, I only got $21,000 in premium here, but I took most of that and I used that to go buy these call options on Nvidia right here. So I'm basically getting these call options over half off. Basically my cost basis, if this expires out of the money, is pretty much going to be like $26,000. So what does this mean? How does this option play work out? Let's look at it. So my strike price is $100. The expiration date is 6/18 of 2026. So this is the key that you have to understand. And it all comes back to the valuation of the company. Do we feel like Nvidia was cheap at $147 per share? I thought it was. So I was willing to sell a put option then, but I waited and I caught this dip right here. So when I sold the put, it was roughly $120 per share, like I said earlier. So I got it at a discounted price level. So if I felt like Nvidia was cheap up here at $147 per share, I felt like it was even cheaper down here in the $118 to $120 range. So when it was roughly $120 per share, that is when I sold these puts on Nvidia. So what this trade actually means right here is if Nvidia falls to $100 per share anytime between right now and 6/18 of 2026, I'm going to have to go buy shares of Nvidia for $100 per share. But think about it real quick. If I felt like it was on sale at $147 and then I sold the put when it was roughly $120 per share, so it's even cheaper than before, why on earth would I not want to buy it for $100 per share roughly a year and a half out from right now? They're going to have more time to boost their revenue, more time to boost their earnings, more time to make the actual company worth more money. So that's why there's a high likelihood that the share price is going to be well above $100 per share. So that's why I took the premium when I sold this put and I rolled it into this call right here. I do it on many different other companies. You can see I have a few other companies open up right here. And this is only accurate to the time of recording this video. But in a nutshell, that's what I do. When I'm bullish on something, I'll sell a put and take the premiums and go buy the calls. That's how you pretty much almost get free call options, and that's how you make a crap ton of money in your portfolio. This averages roughly $1,000 per day in profit, and you have to understand that there are risks to this strategy right here. The risk is that Nvidia doesn't go up. The market could crash, we could go into a recession, things happen. But when you understand these companies, you know how to evaluate them, you know how to value them, your risk is not going to be as risky anymore. Because just think about a quick example right here, super quick. If I go get in a fight with a pro boxer, is that risky for them or risky for me? It's risky for me because I'm not prepared, but it's not risky for them because they are prepared. So that's exactly how this works out right here. So if you don't feel comfortable evaluating companies and knowing how to value them and know if they're a good trade or not, check out the link below for my course. If you don't want to do that, watch this video right here. It's a little bit more detailed into how I go into stock options, specifically selling put options. I'll see you guys there.